got the right shoes on.
Yes, I do. And this is just audio, so we can do this.
No, yeah, those are legendary right there.
They are, Jason. That was a good call.
Maybe the most worn shoe of the company.
Most commented on for sure.
For sure. People, they catch people's eyes.
Yeah, they do.
Yeah.
I bought a pair of those the day before we got them.
What?
Yeah.
Like the exact pair?
Yeah.
Get out of here.
Yeah, I saw them.
Wow.
And I was like, black and gold. Like, oh, that's my work.
Dang.
My work colors. Like, of course I'm going to get them.
MattyP is bought into Hig.
And then the next day I was meeting with Jason and Danny in Jason's office. And she's like, check out these shoes. Like, and Jason told the story about how he saw somebody at Disneyland wearing them. And he's like, oh, those are so cool. And I'm like, I just bought those yesterday.
That is
to match your gold and black car.
Yes.
Wait,
You do have a black car.
We weren't supposed to tell that part of the story.
Okay, sorry.
All right, let's go. I know Jason needs to use this in a minute.
All right.
I have those socks too.
Yeah, thank you, Matt Knighting.
I think we all do.
Yeah, we all do.
Yeah, we all have those socks. The things that bring us together, right? Shoes, socks, and podcasts.
It's true.
Specifically the HIG podcast.
Oh, what a segue.
Yeah, what a segue, right? I'm MattyP. We are here with Bronson Kaufusi.
Wait, we don't need to do any bumblebees or anything? We're live?
All right, give me Bumblebee. Yeah. All right, good.
Okay.
Anything else? You want to do the clap?
No. All right. That was enough. All right.
No, we're just rolling right into this.
Okay, wow.
We're short on time. We have
let's go.
we have some people coming in.
We do.
They got to
Special
use
guests.
the room. Yeah. Lots of special guests.
Yeah.
But we're here today at the Harris Financial Center. I'm MattyP. Like I just said, Bronson Kaufusi. What's up, Bronson?
Yo, what's going on?
And special guest, one of our favorite guests. Not just because he has such a good name, but because he's always insightful. We have Matt Denning, our CIO.
Howdy doody. Thanks for having me.
Yeah, happy to have you here. We're talking today a little bit about some market trends, market updates, right?
Yeah, a little bit through Q1.
Q1, yeah. Q1's quickly coming to an end. Lots happened.
Yeah, a lot has happened.
Kind of a roller coaster.
Yeah, and a lot of it's because of the new presidency change. There's a ton going on in the markets. So maybe could you give us like your kind of broad look at it all, Matt? Like what are some things that you're looking at right now that you're tracking that are really interesting to you?
First off, I think the punchline is the market's confused. They don't know what's about to happen. They also don't know how to react. So when you're looking at the markets, you look for some tells, those signs that key you in on what's driving the market and if the market is in consensus with their views. And when I say when the market is in consensus with their views, you look at the bond market and the equity market separate, and then sometimes a commodity market or another more niche market, niche relative to equities and bonds, could also be indicators of what's happening. So an example I would give is tariffs.
Yes.
You rightfully mentioned that Trump, tariffs, and what's going on there is a big question mark for investors. And in general, you see the market selling off, the equity market selling off when they think that tariffs are in play, right, and are going to be greater than anticipated, and the markets are rallying back when that's not the case. Well, how does that impact interest rates? Tariffs are inflationary in nature, which means that with inflation, interest rates should, all else equal, go higher in anticipation of having to neutralize that inflation, having to dampen the economy. Last week, there was a day where Trump came out and said, oh, actually, I'm not going to be as strict with these tariffs, or choose your adjective. And the equity markets rallied, but interest rates were higher. When you see some signs like that, it's an indicator that the market is confused and doesn't know how to react. Now, there could have been a separate and unique, a distinct reason why interest rates would have gone higher that had nothing to do with tariffs. But on that day, there really wasn't anything. And when you ask about what do professionals in the investment space look at as they monitor the market, it is looking at these anomalies which occur, which are the indicators of confusion or consensus, or what are the top two or three things driving the markets. But clearly tariffs and the Trump policy implementation is a big question mark that investors have. And just greater than that, you do have this whole economy recession theme, which was shelved when Trump was elected. Everybody felt like that the risk of a recession was off the table. or at least greatly neutralized. But now with tariffs and how that could impact things, it's creeping its way back in. I don't think it's the foremost risk that's out there right now.
Yeah.
But it's being considered for sure.
I know. I have so many questions to ask you because I love listening to podcasts and listening to different people's takes. But I think one thing, could we play a game of best case, worst case?
Sure.
Let's play best case, worst case right
like
now.
it.
I love best case, worst case. So we always got to do the hard things first. So worst case. So worst case.
Yeah.
Moving forward. I mean, what's happened? What we know now. What's the worst case over the next little bit that you're like?
So when I play the best case, worst case game, it's not truly the worst case because the worst case is a meteor hits us and we die.
There we go.
Okay.
Almost worst case.
But it's a worst case that is plausible.
Yeah.
Some are familiar with this black swan term.
Yes.
And I seem to love. I'm not talking about a black swan scenario. I'm talking about a realistic worst case. So let's take the optimistic view of Trump's policies. That they are going to help us in the long term. Well, it is natural that when you have these years and years worth of an unbalanced situation that continues to build, whether you want to judge that by the national debt or you want to judge that by trade, world trade, and tariffs impacting world trade and the like, to think that these things can be corrected without any near-term consequence is unrealistic.
Yeah.
Near-term pain for long-term gain. So what is a worst case or what is a realistic bad case? It's that we rightfully implement policy that will help us for the long term, but we have to expect the short-term pain as we adjust.
Yeah,
as we adjust with trade partners and onshoring jobs. There is a process and a period of shifting manufacturing and adjusting for tariffs, and that can cause real pain in the interim, and it can cause inflation.
Yeah.
So to me, even with an optimistic view that we're doing things right, it's very realistic to think that we could have pain. Now, how will that impact interest rates? Right?
Yep.
You have an economy conversation and an interest rate conversation. So it's very realistic that the economy could be impacted, that we could go into a recession. Completely on the table. What would happen to interest rates and how that would impact the stimulative nature or the contractive nature of interest rates, whether they're high or low, right? Ease of borrowing. That to me is a more tricky conversation on how that would play out, but it's absolutely on the table that there could be a fear of inflation. The stagflation conversation is what comes. And I believe that if you look at this over history, stagflation refers to some benign levels of kind of a weakening economy and inflation. If the economy is falling off a cliff, even with some inflation, which is really hard to do, by the way, those two things to be congruent, but the Fed's not going to increase interest rates. Rates won't go higher in that scenario. But there's a scenario where rates go higher and the economy is softening and in a recession.
Wow. So let's talk about that for a second, because that's something I want to cover, recession. I mean, we've heard it in years past. Tell us, how do people prepare for that, like on the investment side? Because it's kind of a unique, I mean, we're in real estate, right? Yeah. We're in truck stops and in multifamily. We're in that area more heavily looking at truck stops. Maybe you could just touch on that.
Yeah.
How it affects us and what we think about it.
Yeah. When you look at recessions, you only know about them in hindsight. As many are aware, these economic numbers are adjusted as the quarters go on. And so you'll have a release of Q1 GDP, Q1 2025 GDP, and at the same time, they revise the Q3 2024 numbers and the Q4 2024 numbers because they're getting updated information that is taken into account. And so it's not uncommon to be like, oh, guess what? We didn't realize it, but we're now in a recession because what we thought was 0.2% GDP growth 2 quarters ago was negative 0.1, and the negative 0.2 last quarter is now a negative 0.6. We are technically in a recession. Now, markets are forward-looking. They try to anticipate this, but the market is still inefficient, and many times the market doesn't fully appreciate a recession and doesn't bake it in. And so as we're getting those revised numbers, even though it's a forward-looking market, it adjusts to the current data set and continues its sell-off. The good news is that recessions normally don't last too long. Yeah. Obviously, we can point to extreme examples in the past, in the 1900s, where there were prolonged periods. But we have been able to get out of these fairly quickly. And even if you look at 2008, 2009, for a long-term investor, for having even just a medium-term hold period, it hasn't been that drastic or dramatic.
Yeah.
You can withstand this with just staying in the market and staying alive, and maybe you reallocate some assets so you can come out of it stronger, but it's typically not the end of the world.
Yeah. No, I love that. I think that's important to know. Yeah. Because when people start throwing recession around, everyone's like, oh, and it's like, oh, no. We can navigate this. Like, there's a way to do that.
Exactly. Who gets wiped out in a recession? It's levered players.
Yep.
And by the way, in real estate, there are levered positions. And so it's a conversation that we have. Now, how levered are you is the question. If you look back at 2008 and we look in the equity markets, you had retail investors and institutional investors that buy on leverage, buy on margin. Right? They're borrowing money from their brokerage and they get a margin call and they're forced to sell. And there's a domino effect, a compounding effect. So in the financial markets, for certain players, it can be extremely punishing and severe. Yeah. But if you look at it from an economic standpoint, it's normally, again, within a couple of year period, in hindsight, you're not doing so bad and you're probably out of the lows and you know, coming back to your previous highs.
Oh, wow. Okay. No, that brings me to my next question. Going best case for real estate specifically. Yeah. I know we have some great opportunities with bonus depreciation coming back to 100%. We're watching it closely because that does affect us and all real estate investors. But for you, what is the best case on the real estate front?
Sure. Let me mention one thing about real estate, which is interesting, and then go into that best case. Yeah. And it's the following. It has been a difficult period for the last few years in real estate. Part of this is the work from home, and you had the office space that collapsed, so to speak. Industrial stayed fairly strong. Data centers did well. Multifamily struggled. That was more of an interest rate story. And the interesting thing, though, is on multifamily, which is a big market, is that pain happened with the economy actually doing fairly well. And that was weird.
That is strange.
Interesting.
The scary part is, well, what happens if the economy goes into a recession? Because normally that would be a period where there's a rethink of risk assets and what you're willing to pay for them and how it gets impacted. So there should be, with every real estate investor, time spent in how that could impact things if the economy does weaken. Could we have another modest weakening in these markets? I don't think that the multifamily market specifically will have any significant sell-off from this point because it's already experienced a lot of pain with players that were impacted by interest rates, and it's a leveraged game in real estate. And so there has been a lot of pain. But this idea that real estate could just, or multifamily assets specifically, could just hang out at this level or slightly dip if we had a recession, that's on the table. But what is the best case scenario? The best case is that we look back, and although there has been some weakening in rental rates on the multifamily side, and a lot of that was with the supply growth that happened in the Sun Belt market specifically, we look back and we say, hey, that was a 1-year issue. Yeah. And there was pain because of interest rates, but interest rates have not permanently altered the profitability of these assets going forward. And with the market, doesn't even need to strengthen much. You could absolutely see a tailwind in the real estate market. Yeah. Now, I've stated before, and I remain with the same thought, that there are a lot of sellers on the multifamily space that will create a ceiling on the market temporarily. I think for the rest of this year. my gut tells me next year is a better buying opportunity on multifamily than this year.
Yeah.
But listen, that's one man's opinion. We won't know if I'm right until 5 years down the road.
Yeah.
And even if you were early and you suffered a little bit of a pullback over the next 6 to 9 months, I'm not saying that within 3 years you couldn't look back and say, oh, whatever, I was early, but I still made some good money.
Yeah.
Okay, so I'm not criticizing anybody who's buying multifamily today. I just think that the opportunity set will persist into 2026. Yeah. And I have said that on the gas station side, the reason why I think that could really move quickly is because there was no supply-demand issue. It was interest rate focused. And with a healing of the interest rate market, this market could normalize. And then you mentioned Trump and tax policy. And now all of a sudden, if some of those favorable tax policies are reinstituted, now you're adding fuel to the fire. And you could really see some acceleration because gas stations have a great tax dynamic.
Yeah, it's so strong. And I love it. I'm excited. I am hoping that's what happens, Matt.
Well, you know, I have you on the calendar now for March, April of 2030. So we can follow up on this episode 5 years from now.
Good.
So,
I like that.
Oh, man.
But nothing in between.
nope.
Good. I like that even more.
I'm just kidding. I got you on the rope. You'll be here a few more times.
Yeah, as you know, Bronson, we are still actively buying in this asset class today. There's been healing in the interest rate market. We've seen that with cap rates coming in somewhat. So in hindsight, as of today, summer 2024 feels like the bottom. Things are a little bit better today. Now, if you compared today versus 4 years ago, today is multiples better than what it was 4 years ago. So just because the bottom may have passed doesn't mean we don't have a huge trajectory positive that we could see an appreciation of these assets. So that overused adage of buying hand over fist, obviously you're weeding out the best assets within the asset class. There's always bad assets and junk within everything. But we are actively seeking to grow our portfolio in this space. And we have a lot under contract today, and we think we're going to have a lot of under contract as the year progresses. And it's an interesting conversation. If tax code changes in 2 months, will there be an immediate jump in the asset class? There very well could be.
Yeah, that'd be great.
And there's a chance that in Q4, we're sitting here saying it's just not as attractive buying today versus what it was, today as in December, right? December 1, 2025 doesn't look nearly as good as March 1, 2025. But who knows how to play out? Nobody knows.
No one knows.
No one knows.
Oh,
Exactly.
That's been so good. Seriously. Matt, I'm telling you, you're the favorite one when you come on here.
I thought you were going to tell me that we're getting new tax policy and it's a given. That's what I want to hear from you.
Maybe we should bring a cake in if that happens. That might be fun.
Yeah.
I will tell you this. There will be more than a cake here. We may get gifts from investors in that scenario. It's been a tough few years in the real estate market. Everybody's looking for a win. This really is a great potential setup. And again, nobody has a crystal ball. There are many things that could happen, but I've told both of you before that as I look at markets, you look at the one or two big levers that are impacting markets and what could change things. And I think that on the gas station side, both levers are primed for a positive jump. And the only reason I'm more tempered in my view of the multifamily space is I just think there's still some selling pressure that's out there.
Yeah.
But I don't think that in 5 years' time you will regret having bought multifamily today.
Yeah.
I just think the risk reward in one of our asset classes is a little bit better than the other.
Yeah.
And we have time to scale up the other piece of multifamily.
Which is awesome.
Yes.
So, man, I'm sure people have questions for you. after listening to you because you do such a good job.
Give them your phone number.
Oh yeah, here it is. No, we give them our email, contact@harrisinvestmentgroup.com.
Okay.
Send us questions so that way we can ask Matt all of them next time he's back on. We might have just a question.
March 2030. I will answer them.
We'll see him in 5 years.
It's there.
That's
It's
the
happening.
only solidified date. We'll slide some more in there, but that's the only one that's
Seems like you're renegotiating this. I don't know.
Well, Matt, thanks for being here today.
Okay.
It's always nice having you on. Bronson, been a pleasure. Hope you find your dad.
Thank you. He's out there.
And he is out there. I'm sure he is. Let us know if you have any questions, and we'll catch you next time.
Deal. Thanks.
The HIG podcast expresses the views of its participants and may not represent the views of Harris Investment Group. The views discussed are subject to change without notice. The HIG podcast has no duty or obligation to update the information contained herein. It should not be assumed that past investment performance discussed is an indication of future results. Wherever there is the potential for profit, there is also the potential of loss. This is the very nature of investing. The HIG podcast and its affiliates do not provide tax, legal, or accounting advice. The information shared on this podcast should not be construed as an offering, advisory service, or investment advice. Consult your own tax, legal, and accounting advisors before engaging in any transaction. This podcast, including the information contained herein, is the sole property of Harris Investment Group and may not be copied, reproduced, republished, or posted in whole or in part without the prior written consent of Harris Investment Group.